What is the difference between a long call butterfly and a long put butterfly spread? Have you ever wondered how different options strategies can impact your trading decisions? Today, we will break down the differences between a long call butterfly spread and a long put butterfly spread. Both strategies are designed to profit when the underlying stock price remains near a specific target price at expiration, but they use different types of options. Let's start with the long call butterfly spread. This strategy involves using call options. You begin by buying one call option with a lower strike price. Then, you sell two call options at a middle strike price, which is often referred to as the body. Finally, you buy one call option at a higher strike price. All of these options must have the same expiration date, and the lower and upper strike prices should be equidistant from the middle strike. This setup results in a net debit position, meaning you pay to establish this spread. Now shifting gears to the long put butterfly spread, this strategy is constructed using put options. You start by buying one put option with a higher strike price. Next, you sell two put options at a middle strike price, similar to the long call butterfly. Lastly, you buy one put option at a lower strike price. Just like the call butterfly, all options in this spread share the same expiration date, and the wings are equidistant from the body strike. This spread also results in a net debit position. When it comes to profit and loss characteristics, both strategies have limited risk and limited profit potential. The maximum profit occurs if the underlying stock price closes exactly at the middle strike price at expiration. The maximum loss is limited to the net premium paid to establish the spread and occurs if the stock price moves outside the range defined by the wings. The main difference lies in the outlook and use of each strategy. The long call butterfly is typically used when a trader expects the stock price to stay near a target level with moderate upside potential. This strategy benefits if the stock price rises slightly above the short call strike, because the short calls decay faster than the long calls, increasing profitability. It is often employed ahead of events where moderate upside movement is expected but volatility is low. On the other hand, the long put butterfly is used when a trader expects the stock price to stay near a target level but with a neutral to moderately bearish outlook. This strategy profits if the stock price remains near the middle strike but can be more favorable if the price moves slightly downward within the strike range. Both spreads create a butterfly-shaped payoff diagram with the highest peak at the middle strike price. The long call butterfly is like a short call straddle protected by long calls at the wings, limiting risk if the stock moves too far up or down. Conversely, the long put butterfly uses puts, providing protection if the stock moves too far down or up outside the wings. In practical terms, both strategies are neutral to range-bound strategies used when low volatility is expected. They are ideal for traders who want to profit from time decay and minimal movement in the underlying asset. The choice between a long call butterfly and a long put butterfly depends on the trader's directional bias and the pricing of calls versus puts in the market. So, whether you lean towards a long call butterfly for a neutral to moderately bullish outlook or a long put butterfly for a neutral to moderately bearish outlook, understanding these differences can help you make informed trading decisions.